Hi everyone! August turned out to be a bad month for Wall Street. The situation is unlikely to improve in September. In fact, the first month of autumn may be even worse. Investors expect the main US stock indices to test the mid-June lows. Stocks dropped markedly after reaching a 4-month high in mid-August due to concerns about the Fed's aggressive tightening. The S&P 500 declined by about 7% following Jerome Powell's hawkish remarks last week. Other policymakers also backed further monetary tightening. All three benchmark indices have been extending losses for the third week in a row. The Dow tumbled by almost 3%, the S&P 500 sank by 3.29%, and the NASDAQ decreased by 4.20%. After digesting the non-farm payrolls report last Friday, traders are now looking forward to the CPI index for August, which is due in the middle of the month. This is going to be the last crucial report before the FOMC meeting on September 2021. In the meantime, investors are going to analyze all available information in search of an answer to an important question: will the Fed really stick to policy tightening in the long term? Watch our video till the end and learn the latest news from the stock market. Feel free to leave your feedback down below. Let's start. Wall Street was closed yesterday on the occasion of Labor Day. For this reason, there were no significant changes. Last Friday, market activity was rather high as the long-anticipated NFP data for August was published. The Fed takes into account the results of the non-farm payrolls report when making a key rate decision. It is determined to return inflation to the 2% target. The final report revealed a higher than expected employment rate. Average hourly wages increased by 0.3% versus the forecast reading of 0.4%, and the unemployment rate rose to 3.7% from a pre-pandemic low of 3.5%. Investors saw signs of a slowdown in the labor market. The Fed's efforts to bring down inflationary pressure have affected the labor market indicators. As a result, some traders are now uncertain about a 75 basis point rate hike in September. Currently, only 56% of speculators are betting on the third consecutive aggressive rate hike, whereas previously 75% of traders were expecting it. If inflation figures for August signal a slowdown, the probability of a 50 basis point hike will increase significantly. Market sentiment improved following the release of NFP data. Stocks kicked off last Friday with sharp growth. However, the rally did not last long. Optimism waned as concern about energy crisis in Europe intensified. Besides, trading activity declined considerably before the long holiday, which led to high volatility. The Dow Jones lost more than 300 points last Friday, while the S&P 500 and NASDAQ slid down by 1.1% and 1.3% respectively. The non-farm payrolls report failed to dispel investors' fears about the Fed's aggressive rate hike. Speculators hope that the Fed will pay attention to rising unemployment. However, the regulator will hardly change its stance because of the weakening labor market. Jerome Powell has repeatedly stated that the main priority is to tame inflation, even if there is a risk of a slowdown in economic growth. Therefore, a 75 basis point rate hike is still relevant. This week, several Fed members will deliver speeches. Speculators are sure to look for clues about monetary softening, although there could hardly be dovish statements. Apart from that, the European energy market is also in the spotlight. Russia indefinitely halted gas deliveries via a key pipeline to Europe on Friday, citing on an oil leak in turbine hours after G7 leaders agreed to set price caps for Russian oil. The energy crisis has bolstered the risk of a recession in the European Union, which prompted investors to revise their profiles in favor of safe haven assets. Naturally, this is rather bearish for stocks. All sectors closed in the red at the end of last week except for energy stocks. They maintained growth thanks to rising oil prices. Like other stock indices, the S&P index is going through hard times. It appears the stock market has lost steam once again, getting a run of bad luck. Not long ago, it was expected to hit the bottom. Now it's likely to test the June lows. Since the start of the year, the S&P 500 has fallen by 16.5%, the Dow has slipped by 12.7%, and the NASDAQ has declined by 24.8%. September is historically the worst month for the Wall Street. It means that stocks should brace for a bumpy ride in the near future. For example, the Dow lost about 1.15% in September, as well as the S&P. Its average yield in September totals minus 1.05%. The heavy tech NASDAQ usually tumbles in September by 0.6%. September has always been the only month of the year when the NASDAQ shows weak performance. The September effect tends to worsen in the years when traders are assessing midterm results. Hence, September will hardly bring any positive shifts. The S&P 500 index managed to climb at one of the sessions last week after falling to a low around 3,903. This level turned out to be rather strong. It will not be easy for bears to push the price below this level unless downbeat fundamental reports appear. Many analysts believe that a strong support level is located at 3,900. Its breakout will greenlight the start of a downtrend. If so, the index may approach new lows. As the Fed is likely to raise key rates for a long period, an upward movement of S&P and other stock indices will be limited in the near term. The Fed is expected to raise the benchmark rate by at least another 100 basis points by the end of the year. The watchdog may start hiking rates even more aggressively if inflation keeps rising. The NASDAQ 100 sank by 1.3% last Friday, losing more than 4% over the week. This is the worst result among these indices. The short-term outlook for all three indices remains bearish. At the same time, the sentiment on Wall Street may change by the end of the year. For example, the target level for the S&P by mid-2023 could be 4,200. However, in the near term, the S&P may test a low of June 16 again, which means a decline of 8% from the current levels. The dynamic in the options market is also negative. The number of options for short positions of the NASDAQ is near the highest level since year 2000, when the dot-com bubble burst. Risk assets will unable to regain momentum until the Fed announces its key rate decision and outlines plans for balance sheet. In September, there will be a lot of events that may affect the stock market, namely the FOMC meeting and the publication of the Consumer Price Index. Inflation is expected to exceed the July reading of 8.5%. That's all for now. Subscribe to our channel and keep close tabs on market developments. See you.